Okay, Bismillahirrahmanirrahim. Assalamualaikum. Okay, now we are proceed with chapter 7, yeah, which is common stock or common shares. In this one, I'm focusing more on theory a little bit. Yeah, but calculation is just for the understanding only. So if you look at the definition here, common stock is the equity investment that represent ownership in a corporation. So in Indonesian word or Malay word equity means modal, yeah, or the other word we call it associated as a capital. All right, it's an investment that represent ownership in a corporation. I'll give you an example. Let's say if you uh, invest in ABC, they say ABC company, and then this is you, and you invested some money in ABC company. So if you are invested in ABC company, you are become part of ownership in a corporation. Yeah. Why? Yeah, it is because you are the capital provider. Yeah, you give money for the company. Yeah, and then company will run the business, and their responsibility is to generate the profit. And only corporation or company can issue common stock. Yeah, we never seen an individual sell the stock to one another. Individual can sell common stock, but to the companies only. When we're talking about issue meanings that they are the ones who initiate the ownership, yeah, and sell the ownership to the people. Investor or common stock shareholders. Shareholder means that those who are investors, yeah, have claim to earnings and asset after all claims on preferred stock are satisfied. When we talk about ABC company responsibility is to generate profit. So once they are generate the profit, and the profit will be distributed to the owners first. And let's say if there is a scenario of, let's say, bankruptcy, yeah, or we call it too many debts. And then the remaining asset, after the settlement of bankruptcy or debt, will be returned back to the ownership first. Yeah. So that is the chronology of common stock. And the return on common stock in terms of capital gain and dividend subjected to company's net profit. Capital gain means that, let's say if you buy shares at 1 ringgit, and then you sell it at 1 ringgit 20 cent. So selling minus buying, sell minus buy, you will get 20 cent profit, which is capital gain, from buying and selling shares. And dividend means that we call it profit distribution. Okay, profit distribution meaning that, distribution meaning that if ABC companies generates profit, and the profit need to be distributed among investors or owners. Yeah, so it depends. Yeah, but if the company generates losses, that means there is no dividend at all. Now, what are the features in common stock? Number one, claims on asset and earnings. Okay, it is a last party because priority towards preferred stockholder first. Preferred stock meaning that is a premium investors or premium shareholders. And dividends, as far as dividends is concerned, it is not fixed, subjected to company's net profit and its declaration. The rule of thumb is simple. If higher profit, that means higher dividends. If there is low profit, that means low dividends. But if the company does not have recorded any profit, which is losses, that means there will be no dividends at all. And so therefore, they need to declare the dividend subjected to the company's net profit. The third one is maturity period. There is no maturity period here until companies become bankrupt. Yeah. If the company's age is 60 years old, that means the maturity period is 60 years old. Yeah. And now, yeah, today, tomorrow, until the future, until the company's close. Yeah. As long as company operates, yeah, the maturity is still alive. The next one is voting rights. Yeah, investor or shareholders have right to vote for the board of directors. They have the power to select and vote who will be the potential board of directors in the company, and at the same time, they can sack board of directors too, because they are have power as an owners. The next one is limited liability, whereby risk is only affected amount invested. Yeah, if you invested 1,000, therefore the losses is subjected to 1,000 only. Hold on a second. Okay. The last one is preemptive right. Yeah, because you have shares with that particular company before, which is you are existing shareholders, you have right to maintain the proportionate share of ownership. Let's say if you have 30% shares of the ABC company, and then ABC intends to increase more shares. Technically, if they are increasing the shares, the percentage will become decreasing. Let's say 25%. So therefore, once the additional shares that ABC issued, yeah, the that particular investor have right to purchase more shares just to maintain the whole the proportionate of 30%. These are the types of common stocks. Yeah, so let's have a look at the types and the description there. Blue chip stocks. Yeah, I cut it to the chase that blue chip stock issued by large and well-established firm. Yeah, that means the companies that generates multi-million profits. Yeah, mega companies. Yeah. All right, for income stock, that means issued by the company that have a long and sustained record of regularly paying higher than average dividends. In other words, these are the stocks that issued by a company who recorded a sustainable profit every year. Next is growth stock. That means issued by a small, new, and growing firms which have potential to expand their business. That means we expect that this company will record its good projection of share price. The next one is a tech stock. Tech stock means that stock issued by a firm who is related to technological industry, which is let's say IT, and these are listed on ACE Market in Malaysia. But for Indonesian, we need to check that later. Speculative stocks, that means we are talking about stock issued by a company which sometimes have a stable dividend, a stable profit, and sometimes do not have a stable profit. Yeah, so that means sometimes profit and sometimes losses. Yeah, that means we're talking about company that's recorded the volatility. Yeah, high volatility in terms of price and profit. The next one is a cyclical stock. These stocks earning and overall market performance are closely linked to the general state of the economy. Yeah, it depends on the economics performances. Yeah, because sometimes economic can goes up and goes down. And the last one is defensive stock. Yeah, and we are talking about the opposite to growth stock. Means that defensive stock means that the stocks that issued by a company who have a slightly downward projections of the on the income, and their job is they need to ensure that the price does not go down further. These are the advantage and disadvantages of investing in common stock in terms of investor. When you are an investor, you the first one better hedge against inflation because you have certain income from the investment and you can combat against inflation. Expected return are higher because there are higher risk. Capital appreciation on investment, I relates to the capital gain just now. Next, ownership position through voting rights. Yeah, that means you have a right to appoint board of directors. Fifth, enjoy the preemptive rights. Excuse me a second. The next one is possibility being elected to board of directors. And the last one, liquidity X stock exchange. Liquidity means easy to buy and easy to sell the shares. Investor disadvantages are number one, very high risk in the company. Number two, possibility of cannot claiming asset during the case of liquidation. This one I already mentioned earlier. Yeah, in the process of a bankruptcy, they are the last parties. Yeah, it depends on the remaining balances. Then company not obligated to pay dividend. Investor cannot complain. Yeah, investor cannot complain if there is no dividend. And then dividend do not enjoy tax shields. Yeah, meaning that they still have to pay tax on that. And then the tax rate on dividend is this high. In terms of a company as an issuer, Yeah. Okay. The advantages is the company does not legally obligated to pay common stock dividends. They also do not have maturity date, so they can the common stock can be sold as long as they wanted to, and then the firm can increase its financial base and thus its future borrowing capacity. But in terms of disadvantages, the cost of underwriting and distributing, which is dividend, are quite high. Yeah, because stock are higher than that. And then common stock dividends cannot deductible as expenses. Yeah, this one is one we call it as a retained earnings. And issuing new share will have possibility of ownership change because of the issue of 30% that I mentioned earlier. So these are the common stock valuation. Yeah, we have three models: zero growth, constant growth, and variable growth. So if you look at the similarities and the differences between these three, the similarities is they are using growth model at the same time for these three models. But for the differences is the first one is zero. That means zero growth. That means there is no growth at all. That means no dividend. The second one is constant growth. That means the growth is constant, the same rate every year. For the variable growth, means that the growth rate are different, yeah, yearly. So the decision to buy or sell the common stock, yeah, I already teach you in the bond valuation. If a market price is more than valuation, it is overvalued. That means sell or do not buy. Or if market price is less than the valuation, it is undervalued. That means buy or do not sell. Always refer to your MP because this is the actual price. Let's have a look at the first model, which is zero growth model. Zero growth model, the assumption is there is no growth. Yeah, that means G is not given in the question. Yeah, zero growth means that there is no growth at all. The dividend is flat every year. I give you illustration. Year 1, year 2, year 3, year 4, year 5. So that means the dividend is, let's say, there is no growth, yeah, meaning that the same dividend, yeah, which is, let's say, 1 ringgit, 1 ringgit, 1 ringgit, 1 ringgit, and 1 ringgit. So that means it's a flat dividend. There is no growth every year. So the formula is the valuation of shares, the price of shares is equal to D divided by K, whereby VS is value of price of the stock, D is annual dividend, K is required rate of return. So this is the simplest formula. Let's have a look at this question. Danny is considering a stock purchase. The stock pays a constant annual dividend of 3 ringgit per share. If Danny's required of return for this stock is 12%, how much Danny will be willing to pay for this stock? In this case, there is no G. No G. Why? Even this question doesn't mention anything about growth rate. The growth rate is not given in the question. So dividend is 3 ringgit. K, which is written, is 12%. So using VS, PO also can be used as well. The same meaning is equals to D divided by K. That means you just replace the number with the symbol 3 ringgit divided by 12%. 12 divided by 100 is 0.12. So if you press calculator, 3 divided by 0.12 is 25 ringgit. So that is number one, the first model. The second model is a constant growth model. The assumption is like this. Dividend will grow over a time at a specific rate or grow forever to infinity. So let me give an example. Let's say 1 ringgit at year 0, year 1, year 2, year 3, year 4, and year 5. That means for year 1, let's say 5% growth. Second year, 5% growth. Third year, 5% growth. Fourth year, 5% growth. And fifth year 5% growth. That means the growth for every year have a same rate. Yeah, which is G given is only one. In this case, only 5% given. So the formula is either one. You can use VS is equal to D1 divided by K minus G, or DO 1 plus G K minus G. Because why? The value of D1 is equals to DO 1 plus G. Yeah. So PO, value of price of share stock. D1 is a next year dividend. Yeah. K, DO means last year. K, required of return. G, constant growth of rate. You need to check D1 next year. D0 last year. Now, High-Tech Berhad is expected to pay a dividend of RM1.80 in the coming year. Expected to pay. Expected means that we're talking about future dividend, which is D1. Hmm? Expected to pay in the coming year. Coming year meaning next year. The required rate of return is 16%, and dividends are expected to grow at 7% per year using the dividend valuation model. Find the intrinsic value or value of the stock of the company's common shares. Now, dividend of RM1.80 next year is D1, RM1.80. K is 16, G is 7%. You see, they given only one rate of G, which is 7%. Yeah. Okay. So using the formula of VS equals to D1 divided by K minus G, just put the figures RM1.80 divided by 16 divided by 100, 0.16. 7% divided by 100 is 0.07. Press the calculator, you will get RM2. Remember, you need to solve this one first. Yeah, minus this one first and then this one divided by that one. And the last one is a variable growth model. We are talking about different growth model, different growth rate. Let's say RM1, year 1, year 2, year 3, year 4, and year 5. Now, the variable growth model means that the different year have a different rate. Let's say this one 5%. Suddenly this one is a 7%, 6%, 8%, and also 10%. Yeah. Well, this one is quite difficult because you need to calculate year by year. You cannot do a straight calculation because of a different rate. Okay. So the even though this formula is given, but I have another easy formula, easy friendly formula, because this question given 1G, so I prefer to use by table. Okay, let's see. Melissa company paid a dividend of RM2 last year. Last year means that D0. Yeah, the growth rate is expected to be 4% for the first year. This is year 1. 5% for the next year, which is year 2. And then following year, which is year 3. And the last one is year 4. And the required rate of return is 10%. What is the current stock price? So these are the illustration. Yeah. Year 1, 4%. Year 2, 5%. Year 3, 6%. And this is the final dividend. But we do not put it as 3 because we expected that year 4 until forever, will be 7%. Now, for year 1, for the year 1, we need to calculate D1. For year 2, we need to calculate D2. For year 3, we need to calculate D3. And the last one, we need to calculate SP3, or we call it as a VS3. Okay. So that means if D1, that means here is D0. D2, that means is D1. D3 is D2. Yeah, SP3 means that it's the same D3. So for D1, that means last year dividend RM2 multiplied by 1 plus 0.04 is a growth rate here. And you get this price. You need to work column by column. It's easy for you. Yeah, instead of row by row is quite difficult. For D2, bring it down 2.08 multiplied by 1 plus 0.05 is a growth rate of 5%. You will get this amount 2.18. For D3, that means bring it down 2.18 plus, multiplied by 1 plus 0.06, which is 6%. You get this price. And for SP3, use this formula D3 1 plus G divided by K minus G. So that means bring it down 2.31, 1 plus 0.07 divided by, do not forget that your K is 10% here. Okay, minus 0.07, press the calculator, you will get this one. And we use PVIF, PVIF table, and you will get this value. Remember, go back to the chapter 4, the PVIF table and refer back. For year one, which is that PVIF 10% one. This one PVIF 10% two. This one PVIF 10% three. And this one PVIF 10% three. Because it's a same year. Yeah. Alright, so we get this value. And then for PV of shares, dividend multiplied by PVIF. This one multiplied by this one multiplied by this one, you get this one multiplied by this one, you get this, and then add up everything, you will get this price, 67.33. Okay, that's all for chapter 7, and we'll see you again in the next chapter. Have a nice day and goodbye. See you later.